Coming up, super funds asked to embrace the retirement income covenant. The RBA minutes point to a possible another rate rise and investing in AI. That's next. It's your daily 10-minute business and finance news wrap for this Tuesday, the 18th of July, 2023. Later in Market Day, we'll speak with Robert Talevski from Activam. He takes a look at AI and the RBA's latest board meeting minutes, which suggest there may be another interest rate rise. But first, to superannuation, where funds need to do more to improve the way they're helping their members plan for when they're close to or are in retirement. That's the finding of a review by ASIC and APRA. It follows the government's retirement income review in 2020, which found retirees don't consume their retirement savings. In fact, Treasury noted one large superannuation fund found members who died left 90% of the balance they had at retirement behind. Now, ASIC says the problem is worsening because while there's been an increase in the number of super accounts in retirement phase over the past 7 years to more than 1.3 million, the growth in the benefits in those accounts have greatly outpaced that at $478 billion. So now the review, which covered around half of all APRA-regulated funds, found while most have a plan, many aren't executed. So I spoke with ASIC Commissioner Danielle Press for more. Danielle, why did we need this review? And at the same time, can you explain exactly what the retirement income covenant is?
So the reviews come at a 12-month anniversary of the retirement income covenant. What is the retirement income covenant? It's the requirement that funds have a plan for their retirees and have a plan for taking their members through from the accumulation phase all the way through to their retirement so that they can actually spend safely and ensure that they have enough money for a dignified retirement alongside the pension.
This is because there's an increasing number of people leaving behind a significant amount of money in their superannuation accounts when they die. Is that right?
That's right. We're seeing a lot of people who are using either deliberately or inadvertently superannuation as a bequeathment to their children. That's not what super's for. Superannuation was designed to actually help people live well in retirement. So we think funds need to encourage people to live well in retirement and to give them the tools that they need to be able to understand what that looks like. So what is the income that I'm going to have when I retire? How do I get that income? How do I make sure I've got enough? And not be so scared to spend as they enter into that retirement phase because they don't know what the outcome is going to be in 15, 20 or 30 years.
Can you go into more detail about what the actual report found? Because you also saw, while there's space for improvement, funds have been working on this though.
Yeah, so funds have definitely started to think about it in the 12 months since they've been required to do so, and most funds now have a plan. But, you know, for us, execution will eat a plan for breakfast, right? You need to actually have the rubber hitting the road and doing things. So we need, what we are seeing is funds understanding their members better. We're seeing them understand where their gaps in the data are. We're seeing them thinking about product, but what we need them to do is actually execute on those things and make sure that where there are gaps in their understanding of their memberships, that they're filling those gaps. Where there are gaps in their product suite, that they're filling that gap. And really importantly for me, where they are not engaging well enough with their members, they're actually engaging properly and increasing the service standards for people as they move through to retirement. Because the worst thing our system can do is promise that they'll be there when you need them and not be.
So ultimately, what does this mean for members when they look at this report and say, how exactly does this impact me? And maybe as a side note too, when we're talking about this plan, what does this plan actually look like?
So what is it? I think for members, for me, the core objective of superannuation is to provide a retirement income and to provide that dignity in retirement. So members have a right to expect funds to do that for them. I think what the Retirement Income Covenant does is solidifies that requirement that they do something for their members and do the right thing for their members at retirement. So what can member expect once these plans start to be executed is that they can expect that they will get help from their fund when they require the help from their fund, that they can expect that they can trust their fund to do the right thing by them in retirement and have the right product, and be thinking about all the time, thinking about what is the right product for my members as those members move through the different phases of their lives. Because retirement is not a single trajectory either. So the product that you need the day you retire may or may not be the same product that you need 15, 20, 30 years in. So funds need to be thinking about how they create the right retirement outcome for members and how they actually deliver that in a way that creates trust and confidence in the system and trust and confidence in the individual to be able to do what they need to do and be able to spend without being scared of running out of money at the end.
And wrapping up, so how do funds do that? What are the actions they need to take as a result?
So the actions we think they need to do is they need to understand their members. So collect the data, think about the data, and really understand what the membership looks like. They need to think about what the right product is and how those products are built and delivered to their members. They need to test the product on an ongoing basis. So setting a product and thinking it's going to be right for the next 50 years is somewhat naive. We know that those products are going to have to change and develop over time. So thinking about that. And then finally, really consumer testing and making sure that what we think is right for our members is in fact right for our members. So we've got to design product for the average Australian coming out of into retirement, not just the very wealthy. And I think there is always a tendency to think about what does the very wealthy need, because that's where the money sits. Actually, the people we need to help are those that are retiring with a good sized nest egg, but actually that do need more help and more thinking about what is that, how do we make that product extend over their lifetime.
Danielle Press there from ASIC, and in response, the Association for Superannuation Funds of Australia says the government's recently announced policy to increase the level of retirement advice provided by superannuation funds is a key component to improve retirement outcomes for members.
Now, Market Day on the SBS On The Money podcast.
Australian share market fell today. The S&P ASX 200 down 0.2%, 7,283. For more, I spoke with Robert Talevski from Activam Group.
Australian shares fell marginally, hovering around that 0.5% down for most of today. Losses were mainly driven by mining stocks. BHP, Fortescue and Rio were sort of down around that 1 to 2%. Initially weighed down by data showing that the Chinese economy barely grew in Q2 this year. Local market falls were in contrast to what happened overnight in the US equity markets. US stocks rose last night, riding that sort of momentum from last week of better than expected bank earnings and inflation data. You get the sense that equities are a little bit overbought at the moment, extended from sort of a valuation and a sentiment perspective. We've seen some strong investor optimism in recent months, but however, the probability of a recession is still being talked about, but probably more pushed out into 2024. So even with this risk, equity markets keep rallying.
Okay, let's talk about Australia. The Reserve Bank Board meeting minutes released today. It's basically saying there's another possible rate rise depending on what happens with the economy. What's the RBA telling us? And what about the markets? What are the markets saying about the next move in rates and where a peak could be?
Yeah, so the RBA released its 6th of July policy meeting minutes today. Let's remember the RBA's decision to put rate increases on hold this month, flagging that it wanted to see more data and the effects of, increasing interest rates over the last sort of year or so. It left rates at 4.1%. In today's minutes, however, the RBA flagged further rate increases potentially might need it to come into effect. Depending on the data, however, in the next few weeks, this data includes inflation data, global economic data, the labour market and household spending. It sounds like the RBA aren't finished with their fight, obviously, of trying to contain inflation. We expect to see the RBA increase interest rates by another 0.25% next month. Markets didn't respond much to this, the minutes being released and this news.
Okay. One thing investors have been super excited about, particularly in the US, because you saw it in all the tech stocks, is this evolution of AI. Where to from here? Because given that there's been so much excitement, has it been fully priced, that whole sector?
Yeah, so the AI-related companies have really pushed US equity markets of late. The Nasdaq is up 34% year to date. The S&P is up about 18% year to date. The key AI beneficiaries include IBM, Meta, Nvidia, Google, and Amazon. So really the tech companies and the chip makers. Goldman Sachs recently predicted that AI would improve global economic growth by about 7% over the next 10 years and improve productivity by 1.5% per annum over the next 10 years as well. So AI could potentially bring these sort of benefits a lot quicker, both to growth and productivity, using this existing infrastructure that we have in that sort of tech side of things. However, there are some concerns about the potential for another 1990 tech bubble, although we currently don't see this risk at these current valuations.
Robert, we've been talking about on SBS World News the way China's economy hasn't really bolted out of the lane following its reopening earlier this year. We saw inflation last week grow at 0%, GDP only a few days ago at 6.3% annually, although that was off a very low base on the same time last year. So what do you make of it, and what does it mean for the Australian economy and markets?
Yeah, so Ricardo, China's economic growth is showing signs of faltering after we see this sort of strong recovery that we've seen post-pandemic. Chinese economy only grew 0.8% for the second quarter this year, less than expected. Year on year, it's still an impressive number. It's 6.3%, but noticeably less than that 7% expected over that period. So Australia's economy and equity markets continue to be very reliant on the health of China's economy. China basically buys 30% of our export, or 33%. So, a slowing Chinese economy will have an impact on Australia's equity markets and economy going forward.
Finally, where do you see the opportunities for investors at the moment?
Yeah, so the investment environment, I should say, remains challenging. Obviously, we think there might still be some equity market upside, but probably to a limited extent. If anything, these sort of rallying equity markets, as we're seeing now, are probably creating more of a downside risk to where they might end up as well. We still prefer larger cap companies over smaller cap companies. We still prefer more developed companies over the emerging markets. And we still like gold and infrastructure and private equity. But Ricardo, the key thing here is remain invested, but be diversified.
Robert Talevski there from Activam Group. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.